Hello everybody and welcome to the Lighthouse Wealth Management Q2 2013 update. This is Henry Becker, Director of Research and Investment Strategy. In the past we have done quarterly conference calls, but as you may be aware we're switching over to doing video/slideshows. For this update it will just be me, but in the future we are working on incorporating video as well as slideshow with all of or a few of the partners. But for this one, while we're working out the technology, it will just be me. So with that said, let's get right into it. So the first thing we're going to cover staff update, Lighthouse Wealth Management updates. Not a lot, but a couple things to go over. Market and economic updates, and then question and answers. So from a staff update, some of you are aware, you've probably met or have seen the posts, but we wanted to just cover once more. We've added some new support advisors. We have Katie Hartz, who is an MBA, originally from upstate New York, went to Penn State for her undergraduate in marketing, and then continued on to Simmons College where she did her MBA. She is a support advisor in working with Tom and his clients. And we also, back in, I'd say February time, we brought on John Kelly, also an MBA from Frederick, Maryland, so he's a hometown person. Went to St. Francis College for both his undergraduate as well as his MBA. He was a quarterback in college at St. Francis. He also will be support advisor working with Andy Wilson and his clients. So if you haven't met him yet, you'll probably meet him as you come through or attend events with the company. We're really excited to have some fresh, young, energetic staff. So if you see them in the office, be sure to welcome them. Then, just as an update as well, we have the shredding event going on here in Newmarket on Saturday, May 4th from noon to 4. That's at Mealy's restaurant here in Newmarket, Maryland. So that's the staff and updates for Lighthouse at the moment. And let's move on to a market update. So what we have here in one slide, we have two things. We have the blue line, which is the S&P 500. The green line is the ISM Composite Index. ISM is the Institute of Supply Management. It's a private company, or I think it's a private company, whether profit or nonprofit, but they are a private company. And they do a monthly survey of businesses, and they gather lots of data, and then they make a composite index to talk about the overall health of business in America. So as you can see from the green line, if we look recent, the trend has been trending down, we would say. The lows are getting lower, highs are getting lower, except there was a recent high right here that was a little higher. But the one thing that we're pointing out, and you may have seen this if you've been reading the weekly commentaries, I used this chart. What we have is these three red circles where we have divergence, meaning the ISM is going one way and the S&P 500, or we'll call it the stock market in the United States, going the other way. But when we have this divergence, we also see we've had tops in the market. When we see the divergence, the market continues to go up in the face of this economic divergence. But twice now, we've seen the markets coming down. So here we sit today. This is just one of those points where we've been beating the drum of caution because there is a very large disconnect between the economy, global as well as domestic, and the investing markets. So next we have a chart of the S&P 500 and the 10-year Treasury yield. SPX is the S&P 500 symbol. TNX is the symbol for the 10-year U.S. Treasury yield. The red line is the S&P 500. The blue line is the yield on the 10-year Treasury. 10-year Treasury yield, you would read when you look at this, instead of it being, it's not 16.93, it's actually 1.69, so roughly 1.7%. it shows this way for charting purposes. It's easier to read it if they display it like this. So the point here is, as you can see, the markets became broken right around here, late summer of 2011. You can see the two lines kind of moved together until that point. So what we have now is stocks and bonds are both rising together. Stocks more than bonds, but nonetheless, typically they move opposite of one another. So this disconnect is something we pay attention to, because it's not natural. It's not the way the markets are supposed to work. So if we move on. So next we have a chart most people are not used to looking at. These are called point and figure charts. This is how Charles Dow, the founder of the Dow Jones Industrial Average, more than 100 years ago, this is how they charted stocks and the markets. And what you have is ascending columns of X's, which you see here, and descending columns of O's, which you see here, which is where we are currently. And what this is it's showing you this particular chart is called the bullish percentage on the New York Stock Exchange. And as you might think, the bullish percentage could be anywhere from 0 to, I cut it off a little bit, to 100, right? We cut off at about 90, which we've not been at since ever. But nonetheless, this goes back to 2005. So what you see is in this chart that anytime the bullish percentage gets over 70, meaning more than 70% of the stocks on the New York Stock Exchange are trading in a favorable pattern. Anytime we see it get up in this, we'll call it in the rarefied air above 70, there's typically a draw down in stocks. You see these ascending columns of X's turn into descending columns of O's. And they can be quite steep. I mean, as you can see, back in 2008, we had the big drop in the market. So the converse to caution when the markets get over 70 is when the markets get below 30. You can see there's been ascending columns of X's. So basically, this is a way to take the temperature of the broad marketplace. Is there demand for shares or supply building up? There's demand for shares when you see the X columns. There's supply building up when you see the descending O's. So more or less, what this is telling us since April started, which is represented by the number 4, April of 2013, we've seen the market supply for shares building up, not demand. Hence, the market been rather weak lately. If we move on to an economic update, we're looking at after-tax corporate profits as a percent of national income. And you can see that in the blue lines. The green line is the Dow Jones Industrial Average. The red line is average corporate profits. And this chart goes back to 1929. The last time we saw the corporate profits as percent of national income at 10% or more was 1929. All of us know what happened then. I'm not saying that happens now, but it's something to pay attention to. What this means really when you look at it, why is it meaningful that after-tax corporate profits as percentage of national income? After-tax corporate profits are very high right now for a number of reasons. One of the primary ones are corporations have cut their expenses to the bone. They've trimmed a lot of employees, so they're profitable. They're making money. But at the same time, they're doing it with less people, meaning employment is heavily impacted. And the other thing, too, is when you cut to the bone, you tend to not be able to cut much more, which means it's hard to boost profits from here. So it's getting really hard for companies to make money. That's why we're seeing a lot of mergers and acquisitions. That's why we're seeing a lot of companies buying back shares. It's an easy way to boost earnings and so forth. So it's one of these extreme data points that we're looking at. I mean, I would call this extreme because we haven't seen it since 1929. So again, one of those points where we say caution should be taken. This chart's a little more complicated than a normal chart, but it's not so complicated. The blue line is total civilian employment, year-over-year change. And then we have the green line, which is the average hourly earnings, year-over-year change. And the thing really to point out is right here we see the two diverge, and diverge greatly, where employment is up, but average earnings is down. So what you would extrapolate from this is that while more and more jobs are being added, they are lower paying jobs. It's, in some other charts I've shown in weekly commentaries, what you see is an increase in the number of 55-year-olds or greater taking jobs and being added to the employment figures. And what you see is not such a great increase or decrease in people under the age of 55 in employment. Not that there's anything wrong with 55-year-olds working, but the unfortunate thing is, in most cases, these are people that are being forced to take jobs because their income from their investments aren't high enough, or they just need more money. They can't afford to retire, so to speak. So in this last chart, what we have is average quarter-over-quarter change in G20 GDP and the weighted GDP. So G20 is the group of 20, which is the 20 more or less largest countries in the world, and their GDP, their gross domestic product, their growth or not lack of growth in their economy. And then we have it weighted, meaning if you look at the average, you're taking all countries and taking the average. When you do a weight, you're basically saying, all right, well, the U.S. and Europe make up a large part of the world, so let's look at those and give them the appropriate weight versus a smaller country like Indonesia, which doesn't make up a big part of global GDP. But the reality is the chart shows whether it's the change in GDP or the weighted GDP, both are declining. So again, something to pay attention to, considering the investing markets have been going the other way, which leads us into questions. So we solicited clients for some questions, and we got a few back. So I'm going to address the three questions we did get. One is, am I missing something? The economy appears to be floundering, but stocks rising. Can we comment? Good observation, which is kind of the point, one of the larger points in the presentation for this quarter, which is it's true. The global economy as well as the domestic economy is kind of floundering, and stocks are rising. In our opinion, a lot of that has to do with global central banks printing money or quantitative easing supporting their economies. We've seen a few times now where the Fed has hinted they might back away, or that there is no quantitative easing program being used, and we've seen markets sell off. So very simply, our comment is the economy is rather weak, global as well as domestic, but that money printing works really well at boosting the markets, at least for now. What's happening in precious metals? We saw precious metals have been pretty weak, more or less since the beginning of the year. A lot of this is a function of a few things. A lot of people mistake the stock market for the economy, and therefore you see people think, oh, the economy's getting better because the stock market's going up. So you see rotation out of particular assets. But more in specific, it's our opinion that precious metals, just like interest rates and money creation, can be manipulated. And precious metals, in our opinion, get played with. The price gets played with because there's two real versions of precious metals. There's the paper version, meaning the futures market where they set the price, and then there's the actual physical demand, meaning you walk into a coin shop or you call a precious metals dealer and you ask to have precious metals delivered to you. Physical precious metal demand is at more or less all-time highs. In silver in particular, it's been the month of February was the strongest month of U.S. Mint sales in silver, and gold has been right up there as well. So you can easily explain the divergence between physical demand and price. Physical demand up, price down. That means there's a disconnect. And the easiest way to explain the disconnect really is that there is manipulation. And manipulation's been hinted at in Fed minutes, Federal Reserve minutes, meeting minutes in the past. And just some of the movements in the market would lend that. But that doesn't mean someone should not have precious metals in a portfolio, because for 2,000 years, precious metals has been the easiest way to maintain purchasing power, and we think that's important. Third question, are bonds still worth holding? And this question really is pointing to the fact that interest rates are so low, and once they start rising, the value of bonds will decline. And that's very true. But the reality is the Fed and global central banks have been successful at sitting on interest rates in most parts, not necessarily in Germany and some parts of Europe, but the bottom line is, until the Fed either decides to move interest rates up or the market moves against the Fed and interest rates go up, bonds are still worth holding in some measure, not the entire bond market, but certain aspects of the bond market. And we address that in client portfolios appropriately by not holding broad indexes that hold treasury bonds and those types of things. We're more focused on strategic managers or corporate bonds, which we think there's more value in. So there's our 3 questions. This has been the update for the second quarter of 2013. As I said, we will be working on rolling out more technology with the quarterly updates, whether it's video, slideshows, or a combination of the two. Hope you enjoyed the slideshow, and if you have further questions or issues, always feel free to reach out to us. Thanks again.